Cerebras Systems just lost roughly a fifth of its market capitalization in a single trading session. And most of the commentary you've seen today is either catastrophizing or dismissing it. Neither is useful. What actually matters is the specific mechanism that caused this move, because CBRS didn't fall 20% randomly. There's a precise chain of events that explains it. And once you see it clearly, you'll also see what the market is actually pricing in right now. The real question isn't whether this was a crash. It's whether the crash was rational. Let's start with what we know, because precision matters more than speed here. Cerebras Systems entered 2026 as one of the highest-profile AI hardware names in the public market. A direct challenger to NVIDIA in the inference and training chip segment, built around their wafer-scale engine architecture. The stock had run hard on AI infrastructure optimism, and that kind of valuation always carries hidden risk. When sentiment-driven stocks get expensive, it doesn't take a catastrophic event to break them. It just takes a crack. What happened today falls into a category Wall Street calls a multiple compression event. Reports circulating as of this session indicate a combination of factors landing simultaneously. Analyst downgrades citing concerns about customer concentration risk, new data suggesting that at least one of Cerebras's flagship hyperscaler contracts is under renegotiation, and broader macro pressure on capital expenditure budgets across cloud providers who represent the primary buyers of AI compute hardware. None of these individually would move a stock 20%. Together, they attacked the core thesis. Here's what beginners need to understand about how that mechanism works. Cerebras trades at a premium to revenue, like most high-growth AI hardware names, because investors are paying for projected future dominance, not current earnings. When even one piece of that forward narrative gets questioned, the market doesn't just reprice today's numbers. It reprices every year of the forecast model. A 10% reduction in projected 2028 revenue can justify a 20% stock decline today if the market was already pricing perfection. That's not irrational. That's just discounted cash flow. Math working in reverse. The crash wasn't chaotic. It was arithmetic. This is the section where most financial content goes soft, because saying something definitive requires actually taking a position. So here's one. A 20% single-day decline in CBRS is probably oversized relative to the information that became known today. But that doesn't automatically make it a buy. Let's separate those two ideas. Oversized reaction and buying opportunity are not the same thing. Markets systematically overshoot in both directions on low-float, high-sentiment names. Cerebras has characteristics that amplify volatility. It's a relatively recent IPO. Institutional ownership is still being established. And retail sentiment around AI stocks in 2026 remains emotionally charged. When fear hits a stock with that profile, the move goes further than pure fundamentals would suggest. That's observable, not speculative. But here's the other side of the ledger. Cerebras faces structural competition risks that this sell-off brought back into focus. NVIDIA's installed base advantage is enormous. Custom silicon from hyperscalers, Google's TPUs, Amazon's Trainium, Microsoft's Maya compresses the total addressable market from the top. And while Cerebras's wafer-scale approach is genuinely differentiated, differentiation in semiconductors only converts to durable revenue if you can win and retain contracts at scale. The customer concentration concern isn't noise. If a significant portion of revenue is tied to one or two hyperscaler relationships, a renegotiation isn't a footnote. It's a thesis event. So where does that leave the fundamental read? The business is not broken by today's news, but the valuation premium that existed this morning was pricing zero execution risk. That premium is now smaller, which is arguably more honest. Whether it's cheap enough is a separate calculation entirely, and one that depends on your personal risk model, not ours. This is not financial advice. What we can say is that the stock is now having a different conversation with reality than it was 24 hours ago. If you watched CBRS today and felt either panic or excitement, that emotional signal is worth examining, because it tells you something about how you're positioned, both financially and psychologically. Here's the broader pattern that today's move fits into. In every major technology cycle since at least the early 2000s, there's a phase where the real-world deployment of a transformative technology creates a class of high-growth infrastructure stocks that price in an enormous amount of forward optimism. Those stocks perform exceptionally during the euphoria window. They become extraordinarily dangerous when the market begins separating winners from infrastructure commodity plays. Because at that point, the stocks that were priced for dominance but deliver adequacy get re-rated violently. We are in that phase of the AI infrastructure cycle right now in mid-2026. The question being asked of every AI hardware and software name is no longer, are you growing? It's, are you the one who survives to capture the durable margin? That's a harder question, and it demands a higher standard of evidence. For anyone building a portfolio with AI exposure, today is a useful stress test. If a 20% single-day decline in one position caused you to question your entire strategy, your position sizing is too aggressive relative to your actual risk tolerance. That's not a moral judgment. It's a portfolio construction observation. Conviction and position size need to be calibrated together. Secondly, events like today are where information asymmetry actually matters. Investors who had already done the work on CBRS's customer concentration, contract structure, and competitive positioning weren't surprised by today's narrative. They had a framework to evaluate it in real time, rather than react to a number on a screen. The AI build-out is real. The opportunity is real. But every infrastructure cycle produces both Cisco's and Juniper networks. And in 1999, they looked identical from the outside. So CBRS dropped 20%, not because the AI infrastructure thesis collapsed, but because the market was pricing perfection, and perfection developed a crack. That distinction matters enormously for how you respond to it. The real follow-up question worth sitting with: if the hyperscaler custom silicon build-out continues to accelerate through the rest of 2026, which AI hardware companies actually have a moat? And which ones are infrastructure plays that get commoditized? That's the next video. Subscribe so you don't miss it, and drop your read on CBRS in the comments.